Welcome to Mortgage Map. Navigating the mortgage application process can feel like swimming in a sea of paperwork and complex disclosures. To protect consumers from hidden fees and deceptive lending practices, federal regulations enforce strict timelines on when lenders must disclose financial information. One of the most important consumer protection guidelines is the 3-day loan estimate rule. This rule is designed to give you clarity and prevent you from being surprised by unexpected closing costs or high interest rates late in the transaction. However, many homebuyers do not understand when this clock starts ticking, what information the lender is required to provide, and how to use this document to shop for the most competitive loan. Today, we will break down the 3-day loan estimate rule. We will explain the definition of a mortgage application, the key sections of the loan estimate document, and how to use it to protect your budget. Let us first examine what the 3-day loan estimate rule is and how the mortgage application process triggers it. Under the Real Estate Settlement Procedures Act and the Truth in Lending Act, lenders are legally required to provide you with a standardized 3-page document called a loan estimate within 3 business days of receiving your completed mortgage application. This document outlines the estimated interest rate, monthly payment, and total closing costs for your loan. A business day under this rule is defined as any day the lender's offices are open to the public for carrying on substantially all business functions. But what constitutes a completed application? Federal regulations define a completed mortgage application using a specific 6-piece credit application checklist, often referred to as the Aliens Rule. The 6 pieces of information are your name, your income, your social security number to pull your credit report, the property address, an estimate of the property value, and the mortgage loan amount requested. The moment your lender has all 6 of these details, the 3-day disclosure clock starts ticking. The lender cannot delay issuing the loan estimate by asking for extra documentation, such as tax returns or bank statements, before they send you the form. This rule ensures you receive a formal, standardized estimate early in the process, preventing lenders from using delay tactics to keep you from shopping around. If a lender fails to deliver this estimate within the 3-day window, they are in violation of federal compliance standards. This strict timeline forces lenders to act efficiently, providing you with a clear written outline of your prospective loan terms before you pay any application or underwriting fees, other than a reasonable credit report fee. This initial phase sets a professional tone for the entire transaction. Second, let us analyze the critical sections of the loan estimate document that you must review. The form is structured to be easy to read and is divided into 3 key pages. On page 1, you will find the loan terms, including your loan amount, interest rate, and monthly principal and interest payment. Crucially, this page indicates whether your interest rate is locked or floating, and whether the loan contains features like a prepayment penalty or a balloon payment. Page 2 provides a detailed breakdown of your estimated closing costs, divided into loan costs and other costs. Loan costs include origination charges, which are fees the lender charges to set up the loan, and services you cannot shop for, such as the appraisal and credit report. It also lists services you can shop for, such as the title insurance and settlement agent services. Other costs include prepaid items like homeowners insurance premiums and property taxes that must be placed in escrow. Page 3 contains a useful comparison table that helps you evaluate the loan's long-term cost. It shows the total amount of principal, interest, mortgage insurance, and loan costs you will have paid after 5 years, as well as the annual percentage rate, or APRL. The APRL represents the true cost of borrowing, incorporating both the interest rate and the upfront fees. Comparing the APRL across multiple loan estimates is an excellent way to see which lender is offering the most cost-effective loan package. You should also pay close attention to the total interest percentage, or TIP, which shows the total interest you will pay over the life of the loan expressed as a percentage of your loan amount. This metric exposes the true weight of interest payments over a 30-year term, helping you understand the long-term debt cost. Finally, let us discuss how to use your loan estimate as a shopping tool and what fees are permitted to change later in the transaction. Once you receive your loan estimate, you are under no obligation to proceed with the lender. You can use this document to compare offers from multiple lenders side by side. Because the form is standardized by law, you can easily compare page 2 fees to identify which lender has the lowest origination charges. It is important to know that the fees listed on the loan estimate are subject to strict tolerance rules. Lenders are not allowed to significantly underestimate fees to win your business and then raise them later. The law divides fees into 3 tolerance categories. Zero tolerance fees cannot increase at all. These include lender origination charges, transfer taxes, and fees paid to third-party providers chosen by the lender. 10% tolerance fees can increase by a maximum of 10% in total. These include services you can shop for where you select a provider from the lender's recommended list. No tolerance limit fees can change by any amount. These include prepaid interest, homeowners insurance, and property taxes, which fluctuate based on market rates and closing dates. To make the most of this rule, follow 3 simple steps. First, collect loan estimates from at least 3 different lenders. Second, negotiate with lenders by asking them to match lower origination fees shown on competing forms. Third, verify that your final closing disclosure matches your loan estimate. By understanding this rule, you can protect your wallet and secure a competitive mortgage. This structured comparison strategy ensures you remain in complete control of your home financing, allowing you to reject high origination charges and secure the most cost-effective terms available in the market. Mortgage Map is a calm guide for first-time buyers and curious homeowners navigating the home buying process. The channel explains down payments, interest rates, closing costs, pre-approvals, refinances, loan types, and common mistakes with real numbers and simple visual examples in plain English without financial advice or market hype. This video is general mortgage education, not financial, investment, legal, or tax advice. We are not a lender and do not recommend specific loan products. Mortgage programs, rates, and terms change frequently. Consult a licensed mortgage professional before making financial decisions.